Have you ever experienced this? You were reading about someone you admire, then found out they made a bad money choice and you thought they were out of their mind. Or maybe you heard about a relative or neighbor who was once rich but lost almost all their money quickly, and you got mad because they couldn't manage it. Many of us have had experiences like these. When you see how people handle money, you might think some of them are crazy. But no one is really crazy. People make bad money decisions all the time, but it's not because they aren't thinking right. It's just that when it comes to money, everyone is different. Everyone has their own experience with money and the economy. The story of the Great Depression is well known. After the stock market crash in 1929, the global economy declined for a decade. In the US, the Roaring '20s ended suddenly. Businesses closed, families lost their farms and homes, and savings vanished. Poverty and joblessness soared, and people lost hope for a better future. Today, this is the common story we hear. It makes sense because it reflects the experience of millions of Americans, but it doesn't tell the whole story. When John F. Kennedy ran for president in 1960, he was asked about his experience during the Great Depression. His answer surprised many. The Kennedys were already wealthy in 1929, and their wealth grew over the next decade. By 1939, they had more servants and lived in a bigger house. Kennedy only realized how bad the Depression was for others when he read about it at Harvard. Not all Americans were affected in the same way. Kennedy wanted to change this and convinced voters he understood their struggles, proving he wasn't just an out-of-touch elitist. It's not only the rich and poor who have different experiences with money. We all do. The son of an unemployed farmhand and the son of a successful stockbroker learn different lessons about money, risk, and reward. This is true even for equally wealthy people, depending on their life experiences. For example, a wealthy person who grew up with high inflation will view money differently than someone who only experienced stable prices. These different perspectives shape how we handle money. We all like to think we understand the world, but we usually only see a small part of it. The first thing to understand about the psychology of money is that we know less than we think. Housel says that your experience with money is just a tiny fraction of what everyone else in the world experiences. People from different generations have different views about money, which affects how they do things, like investing. For example, if you were born when prices were stable, you might prefer to invest in bonds. But if you were born during a time of high inflation, you might make different investment choices. Doing well with money has a little to do with how smart you are and a lot to do with how you behave. And behavior is hard to teach, even to really smart people. Morgan Housel. We've been taught to believe that our results are entirely due to our actions. If you fail, it's because you did something wrong. If you succeed with an investment, it means you're a good investor. But reality isn't always like that. Smart, well-planned investments can fail, and sometimes profits come from risky decisions. Clearly, success involves more than just being smart and working hard. Luck plays a role too. We can't measure how much luck contributes to success, but we know it's real. Success often involves favorable events, like meeting the right mentors or being in the right place at the right time. That's luck. It's prideful to think all your successes are only because of your hard work. The same goes for failures. Some failures happen because of bad luck. Things like death, accidents, and uncontrollable world events can make people seem like failures. So, don't judge people's finances without knowing their full story. We can't control luck and risk, but we can focus on things we do have control over. It's wise to maximize what we can control. Personal experiences influence how people make financial decisions. Economists often create models based on the idea that people make rational, self-interested choices to maximize their returns. But real life is more complicated than that. Take the lottery, for example. The average low-income household in the US spends $411 a year on lottery tickets. At the same time, about 40% of all households struggle to find $400 for an emergency. Not surprisingly, this 40% includes the same low-income household spending over $400 on lottery tickets. Is this behavior rational? Not really, but it's not entirely illogical either. If you're living paycheck to paycheck, you likely don't have enough money for essentials, let alone luxuries like vacations. Playing the lottery is a long shot, but for many, it's the only shot they have at getting the things wealthier people take for granted. These kinds of irrational decisions are more common than you might think. In a 2006 study, economists Ulrich Malmendier and Stefan Nagel analyzed 50 years of data from the Survey of Consumer Finances, which looks at how Americans manage their money. They wanted to understand what influences people's investment choices. Their answer? The state of the economy when the investors were young adults. In other words, our personal history shapes our attitude toward risk. This isn't the kind of rationality found in economics textbooks, but it makes intuitive sense. For example, if inflation was high when investors were in their late teens and early 20s, they were unlikely to invest in bonds later in life. If inflation was low during those years, they felt comfortable investing in bonds as they got older, even if inflation increased later. The same pattern applies to stocks. If the stock market was doing well when people were young adults, they continued to invest in it. If it was weak, they avoided it. For instance, if you were born in 1970, the S&P 500 grew tenfold during your mid-teens and early 20s. Anyone who invested in those stocks made a lot of money. People born in 1950 had a different experience. The market was mostly flat during that period in their lives. Importantly, these investment decisions didn't change even when the market conditions changed, showing that early life experiences strongly influenced their financial choices. The economic concepts we use today are still very new. Think about a toy poodle. It doesn't look much like its wild ancestors, which were similar to wolves. This is because modern dog breeds have been domesticated for about 10,000 years. Yet, dog owners are often surprised by their pets' instinctual reactions to squirrels or cats. Despite millennia of domestication, these wild traits haven't completely disappeared. So, what does this have to do with the psychology of money? A lot, actually. Why are so many of us bad at handling money? One reason is that it's pretty new in the grand scheme of things. The first currency was issued around 600 BC by King Alyats of Lydia in what is now Turkey. And that's nothing compared to more complex economic ideas. Take retirement, for example. Before World War II, most Americans worked until they died. Life expectancy was lower, and even in the 1940s, half of all men over 65 were still working. Things started changing with the introduction of Social Security after World War II, but retirement remained out of reach for most American workers until the 1980s. That's when the average monthly Social Security check rose above $1,000, adjusted for inflation. Before that, only a privileged few could afford to stop working in their mid-60s. This means that one of the most basic economic concepts we use today is less than 2 generations old. The 401k, the main way people fund retirement, didn't exist until 1978, and the Roth IRA was introduced only in 1998. Other important ideas and practices aren't much older. Hedge funds became popular just 25 years ago, and index funds are only 50 years old. Even consumer debt like mortgages, car loans, and credit cards, key drivers of economic growth in the US, became common only after the GI Bill made it easier for average Americans to borrow money in 1944. If we're bad at financial planning and decision-making, it's not because we're crazy, it's because we're still new at it. Stop chasing money. Modern capitalism has both good and bad sides. On the good side, it helps you build wealth that you can pass on to your children after you die. The bad side is that it creates envy, making you constantly chase after more money. Many people don't realize they are prioritizing money over happiness. The trick of capitalism is so subtle that you might not notice it until you're deeply trapped in it. You might think you're working for yourself and your family's future, but the real reason could be that you're just trying to earn more than your neighbor. This kind of competition can lead you to risk more important things in your pursuit of money, like freedom, time, family, and even your reputation. How many respected people have gone to jail for stealing public funds? If you don't know any, you've probably seen several in the news. This is an extreme example, but more commonly, people sacrifice time and important relationships for work. Happiness can't be compared to money. Don't chase money at the expense of your happiness. The best way to avoid this trap is to understand that more money doesn't mean more happiness. Identify the important things in your life apart from work and money, then create a system that allows you to focus on them. This might mean working fewer hours to spend more time with your family, or refusing shady business deals that could land you in jail. The system will be unique to you, but the goal is to create a balance that ensures your life isn't just about chasing money. Controlling your time is the highest dividend money pays. Morgan Housel. Luck plays a bigger role in financial success than you might think. A couple of years ago, the author asked Nobel Prize-winning economist Robert Shiller what he'd most like to know about investing that can't be fully known. Shiller's answer was the exact role of luck in successful outcomes. Luck is a tricky subject. Most investors and entrepreneurs agree that it plays a role, but it's hard to measure how much it contributes to one company's success and another's failure. We also think it's rude to say someone's success is due to luck. So, we often ignore the role of luck in financial decisions. That's a mistake. Economist Bhaskar Mazumdar found that the income of 2 siblings is more closely related than their height or weight. In other words, if your brother is rich and tall, you're more likely to be rich than you are to be tall. It's easy to explain this correlation. Siblings from the same household often have the same privileges and opportunities. Parents who send one child to a good school usually do the same for their other children. However, if you find a pair of rich brothers, they likely won't believe that Mazumder's study applies to them. This is due to human psychology. We tend to either underestimate or overestimate the role of luck in outcomes. If we succeed, we think it's because we worked hard. If we fail, we blame bad luck. But when others fail, we often attribute it to their character flaws, like laziness or poor judgment. Culture, which is obsessed with success, doesn't help either. Forbes doesn't celebrate brilliant investors who went brunt strokes of bad luck in a sudden market crash. Instead, it celebrates investors who got lucky and made a fortune, even if they were reckless or second-rate. This creates a problem. When it comes to money, we need to figure out what works and what doesn't, while also considering the role of randomness. We might not be able to measure the exact role of chance, as Schiller wishes, but we can still understand and account for luck in our financial decisions. Focus on playing the long-term game. Treat personal and corporate finance as a long-term game, and you're more likely to succeed in the long run. Investors who focus only on short-term gains often don't last. It's not about their skills, it's because no one can perfectly predict the markets. Things change rapidly. You might think you understand the stock market and can predict its next move, but sudden changes can catch you off guard. Many investors have taken their lives because of this. They made massive gains at some points, got greedy, thought they had mastered the market, only to lose all their money and more. Jesse Livermore, a famous investor from the 1920s, is a classic example. He didn't just escape the 1929 stock market crash, he made millions from it, while most investors lost everything. Success is tricky. It made Livermore believe he had mastered the markets. After his huge win, he kept investing and losing but wouldn't give up. His persistence didn't pay off. He lost everything and even ran away from his family for 2 days out of shame. Livermore never recovered from that loss and eventually took his life. Your investing skill can make you money, but you need more than skill to sustain wealth. Investing is risky but offers high rewards. If you get greedy and aim for quick, big rewards, you risk losing your money. The masters of investing understand this and play with a long-term perspective. They choose to compound their gains over time rather than chasing quick, uncertain profits. Take Warren Buffett. As of now, he's worth $84.5 billion, but $84.2 billion of that came after his 50th birthday, and he has been investing since he was 10. His secret is compounding. He is a skilled investor, no doubt, but his acumen alone wouldn't have been enough. When you have a long-term goal and keep compounding at a good annual rate, you have a better chance of building sustainable wealth than someone who is just in it for the quick gains. Focusing on broad patterns rather than specific cases can help you make better calls. Bill Gates once said that success is a lousy teacher. According to Gates, success can trick smart people into ignoring the role of luck, making them believe they can't fail. Ironically, this mindset often leads to failure. So, how should you factor luck into your financial behavior? First, don't obsess over the examples of specific individuals. When we study highly successful people, we often focus on outliers, billionaires who have changed the world, and this can mislead us. Take John D. Rockefeller, one of the most successful entrepreneurs in history. When he started building his petroleum industry, U.S. laws didn't allow him to do what he wanted. His solution? Ignore the laws. His disregard for legal conventions was so extreme that one judge said his business behaved no better than a common thief. Rockefeller's success shapes our perception of his actions. It's easy to celebrate his vision and say he didn't let outdated laws stop innovation. But what if he had failed? Would we still think his example is worth following? Probably not. At best, we'd see him as a failed criminal who taught us what not to do. The difference between these outcomes is luck. Different verdicts or a change in the political climate could have changed Rockefeller's fate. More importantly, good luck is impossible to replicate. Even if you follow every career step of someone like Warren Buffett, you can't ensure the same outcomes. Instead, focus on analyzing patterns of success and failure. The more common a pattern, the more likely it applies to your life and financial decisions. Studies show that people who control their daily schedules are happier with their work than those who don't. Unlike the rare cases of extraordinary outliers, this is a broad observation you can act on right now. Envy can make you reckless. Capitalism excels at generating wealth and envy. Imagine a rookie baseball player earning $500,000 a year. By most standards, he's rich. But if he plays on the same team as a superstar like Mike Trout, who makes $36 million a year, he might feel dissatisfied and want more. High earners like Trout also compare themselves to those who earn even more. For example, to be among the top 10 highest paid hedge fund managers in 2018, You needed to earn at least $340 million that year. Even trout seems small compared to that. Envy isn't morally wrong in capitalist terms, but it does pose a practical problem when is enough enough. Just ask Rajat Gupta. Gupta was born in a slum in Kolkata, India, and worked his way up to become the CEO of McKinsey, worth $100 million when he retired in 2007. He could have done anything, but he wanted to be a billionaire. In 2008, Gupta, a Goldman Sachs board member, learned that Warren Buffett was about to invest $5 billion in the firm. 16 seconds after hearing this news in a conference call, Gupta called a hedge fund manager and bought 175,000 shares of Goldman Sachs. This was insider trading and illegal. Gupta didn't care he made an easy $1 million. By the time prosecutors caught him, he had made $17 million through various illegal deals. It wasn't enough to make him a billionaire, but it did earn him a hefty prison sentence. The moral of the story? Envy leads to bad decisions, and the cost of those decisions is higher than the gains. If you have an insatiable appetite, you'll eat until you're sick. But throwing up is worse than any meal is good, so you don't do that. Leaving opportunities on the table doesn't mean you're missing out, it's recognizing that trying to take everything can lead to regret. In other words, don't be like Rajat Gupta in The Happiness Code. While researching for his book 30 Lessons for Living, Carl Pilner made a surprising discovery. He asked 1,000 elderly Americans to share the most important lessons they had learned over the years. None of them talked about happiness in the way we often do today. Out of all the people interviewed, not one said the secret to happiness was making more money than their neighbor. No one mentioned that pursuing a high-paying career for the sake of money and prestige would lead to happiness. If this is true, and it is, then we are missing something important. Many people believe that more money would make them happier. They pin all their hopes for happiness on a bigger paycheck, leading to very unhappy lives. The Americans interviewed said what made them happy was having meaningful relationships, spending quality time with family, and being part of something bigger than themselves. Numerous scientific studies support these points, showing they should be taken seriously. Nothing matters more than your happiness. It's a mistake to base your happiness on things, especially things you don't yet have, because you might never get them. But when you prioritize relationships and meaningful activities, you find yourself becoming much happier. Don't aim to be rich, aim to be wealthy. The difference between being rich and being wealthy is more than just words. Riches are what people see on the outside, but wealth is usually hidden. For example, someone living in a house worth $200,000 might seem rich. Even if they borrowed money to buy the house, they must be earning a good income to pay off the debt. But that's not wealth. Wealth is having that $200,000 in cash or assets that you haven't spent yet. When people say they want to be millionaires, they often mean they want to spend money like millionaires do. But if you have a few $1,000,000 and spend it all on wants, you're not a millionaire, you're just someone who spent a lot of money. Wealth is the money you save and invest. It's the assets you own. This is what people don't see. Most people only see the display of riches, and anyone can appear rich. In fact, many people who look rich are actually broke. When it comes to building wealth, you have no one to impress. Don't buy things you don't need to show off to people who don't care about you. This advice makes sense, yet people ignore it every day. People buy fancy stuff they don't need because they think it will earn them respect and admiration. But it rarely works that way. When people see you driving an expensive car, they don't think about you. They might assume you're rich, but it doesn't make them respect you. More often, they compare themselves to you and feel driven to achieve more. They're not thinking of respecting you, they're wishing they could be you. So, it doesn't make sense to try to impress others at your own expense. Focus on building wealth, not on showcasing riches you can't afford. Amassing a fortune is easier than keeping it. Few stock market traders in early 20th century America were as skilled as Jesse Livermore. Born in 1877, he helped shape Wall Street and, by age 30, was worth $100 million in today's dollars. Just before the 1929 crash, Livermore made a brilliant move. He took a short position, betting that stocks would fall. When the market lost a third of its value, while others went bankrupt and desperate investors jumped from buildings, Livermore returned home with the equivalent of $3 billion. Happy ending? Not quite. Remember, success can be a lousy teacher. After his big win in 1929, Livermore thought he was invincible. He placed bigger and bigger bets and lost repeatedly, until his fortune was gone. Broke and in debt, he took his own life in 1940. It turns out that getting rich is often simpler than staying rich. It's easy to see why people who excel at making money often struggle to keep it. Making money involves risk, optimism, and courage. Keeping money requires a different mindset, fear that everything you've made could be lost. Staying rich also demands humility. After 1929, Livermore believed he was a genius who couldn't fail. He would have been better off acknowledging that luck had played a role and that his success couldn't be endlessly repeated. There are many stories like Livermore's, though not all are as tragic. About 40% of all publicly listed companies lose their entire value over time. The Forbes 400 list of America's richest people sees a 20% turnover each decade, excluding deaths and intra-family transfers. So, how do you keep what you already have? In one word, perseverance. The most successful entrepreneurs stay in the game for the long haul without wiping out. They all share a common trait: fear. As multi-billionaire venture capitalist Michael Moritz says, when you're scared of losing, you evaluate potential wins differently. Few gains are worth risking everything you already have. You can be wrong half the time and still make a fortune. According to his own account, Heinz Berggruen didn't show much promise in his youth. When he fled Nazi Germany in 1936, he wasn't sure what to do with his life. After studying literature at the University of California, Berkeley, he worked as a journalist and art critic. In 1940, he bought a small watercolor by Paul Klee for $100, sparking a lifelong passion for modern art. Fast forward to the 1990s, and Berggruen had become one of the most successful art collectors ever. In 2000, he sold his collection to the German government for 100 million euros. This collection, which included works by Picasso, Klee, Matisse, and Braque, was estimated to be worth $1 billion and was considered one of the world's most important collections. How did Berggruen amass such an impressive collection? Was it skill or luck? The investment firm Horizon Research offers an interesting answer. According to Horizon's research, all great collectors do the same thing: they buy vast quantities of art. Some pieces turn out to be great investments, especially if held for a long time. Most, however, are not. The key, as Horizon's report notes, is to hold on to the successful pieces until the overall value of the collection reflects the value of the best items. Berggruen's collection was like an index fund. His risks were spread across many investments. Instead of only buying pieces he liked or admired, he bought everything he could and waited for a few winners to emerge. This strategy applies to all investments. It's called the long tail, the idea that a small number of events account for most outcomes. There's complex math behind this principle, but it's simple when boiled down. If you get a few things right, you can afford to get many things wrong. Failure is inevitable. What matters is the impact of your successes. In other words, if you own one Picasso, you don't have to worry about the 99 other pieces that didn't pan out. Conclusion: uncertainty is a natural part of life. We try to predict outcomes and plan our actions accordingly, but things don't always go as planned. Life happens, and we must learn to adjust. If your investment projections work out as expected, that's great. But if they don't, it's important to adapt quickly and change your plans. This is why investors should avoid having sunk costs. It doesn't make sense to stick with a portfolio just because you've invested a lot of time and money into it. Be flexible enough to make changes when things aren't working. Remember, sometimes people make what seem like crazy financial decisions, but no one is crazy. We're all limited by our knowledge, experience, and the market conditions. When unsure of a particular move, seek guidance from more experienced people. This could be a friend, a financial advisor, or someone from an investment club. It doesn't matter who, as long as they have enough experience to guide you. Speaking of investment clubs, there are many both online and offline. Join one if you haven't already. Most require a regular fee, but they are usually worth it. Final words: protect your happiness at all costs. Stay out of shady deals, don't chase money, and always make time for what's important in your life. In the end, what's the use of money if you can't enjoy it? Hey there, thanks for watching. If you enjoyed this video, don't forget to subscribe to our channel for more awesome content just like this.